Robert Johnson, if the Fed is indeed data dependent, what is the data, in your view, telling them to do right now?
Well, the interesting thing about last week's data on employment is that it gave both camps, the camp that wants a rate hike and the camp that wants rates to be kept at the current level, it gave both of them some ammunition. The camp that wants rates hiked, we saw that the unemployment rate dropped. The camp that wants rates to stay the same, we saw that the number of new jobs added was lower than expected. So I think it was a mixed bag. And right now what we're experiencing, I believe, is some Fed fatigue. And I believe that the Fed would be well advised to simply do the rate hike that everybody knows is a matter of when and not if, and get it over with, because the market abhors uncertainty.
All right, so say the Fed does indeed take your advice and hikes rates. Let's talk about the different asset classes it would affect. Let's start off with the REITs. REITs have been down this year for fear of a Fed rate hike, but in your view, they shouldn't be afraid. Why is that?
I think that the market has overreacted with respect to REITs. REITs have actually performed fairly well when the Fed has been raising rates. REITs are one of those asset classes that has done well during a rising rate environment. So I think that the investors who have been fleeing REITs may want to reconsider getting back into that sector.
And emerging markets have been down for a plethora of reasons. The EEM, which is the ETF that tracks emerging markets, is down 15% this year. A lot of people say that a Fed rate hike hurts emerging markets more than a lot of other asset classes. You say, once again, this is not the truth.
Again, the data, and my co-authors and I studied the markets from 1966 through 2013. Over that time period, emerging markets actually did quite well during a rising interest rate environment. In fact, did better than in a falling interest rate environment.
And when yields go up, prices go down on bonds, but you say Treasuries are still better than stocks when the Fed hikes rates. Explain this one.
And that is that the stock performance, large cap stocks have averaged less than 6% during rising interest rate environments over that time period. Long-term Treasuries have averaged in excess of 6% during that time period. It's just what the data tells us.
And according to your studies, the best sectors to be in when the Fed is raising rates, it's consumer goods, it's energy, it's utilities. Once again, that one was a shocker to me.
And it's necessity goods. If you think about it, it makes sense. And I love it when there's intuition behind investments, because often there isn't. But those are goods that people need to buy. People need to heat their homes. People need to buy gas to put in their cars. People need to buy food. Those sectors do quite well during rising interest rate environments compared to other sectors, durable goods, for instance, autos, that are more discretionary goods.
And what should investors do about gold? It's been stuck, I think, around 1,100 for a while now. It's just been sitting there. What do you do with gold if the Fed will raise rates?
Gold hasn't been a particularly good inflation hedge. Gold has not done particularly well in a rising interest rate environment. So despite what all the gold bugs say, I think I'd stay away from gold.
Finally, one more. What about hedge funds? Because the market has been going back and forth lately. One would think that hedge funds would be a great investment nowadays.
Hedge funds have not done particularly well during a rising interest rate environment. In fact, what our research shows is that hedge funds have outperformed when the Fed has been expansive in monetary policy.
And thank you, Dr. Johnson.
Thank you, Greg.
And thank you for watching The Street.